Alan Ruskin, Deutsche Bank's chief international strategist, joining us now to give us his perspective on what we can expect from the Fed a little bit later on. Alan, what do you think we're going to learn today?
Well, the market's got this habit of distilling 2 days worth of conversation into about 2 minutes as they look at the dots. So I think, the focus is very much going to be on, does the median dot shift in 2022 to a hike? That would be a big deal, because that would be the Fed effectively bringing forward rate hikes and maybe being even a little ahead of the market. 2023, there's, I think, actually quite a common expectation that they will lift up their median dots from 2 hikes, that's 2 25 basis point hikes, to perhaps 3 hikes. So I don't think that'd be a huge surprise, but that's a possibility there. And then we're going to learn an awful lot in 2024, really, in terms of how many hikes and where's the point of normalization as far as rates are concerned, and how quickly are we going to get there?
Alan, you mentioned the 2022 bringing forward a hike. It wouldn't take that much of a change in the dot plot, just like 2 dots moving. So it doesn't feel like it'd be that much of a jump. What would be the repricing in the market for that?
Yeah, I don't think it's going to be a huge repricing. I think the market's actually quite split between the idea that the Fed keeps the 2023 dots, signaling 50 basis points, and people who think no, they probably have 3 hikes, 75 basis points. I don't think there's going to be much of a reaction. In fact, I think the real reaction will come if, for example, the 2022 dot shifted. I think that would be the big deal. The 2023 dot, if it just shifts by 25 basis points, I think the response is going to be pretty muted.
What would cause the Fed to be more cautious? There seems to be a long list right now, Alan. You've got what's happening in D.C. The odds of a default seems to be rising. We may get to that point, we may not. We've got what's happening with China. The data more broadly, though, have been slowing down, and I've been surprised that we haven't seen sort of dovish language accompanying that. So I'm kind of wondering what the risks look like on both sides. How do you see the downside risks? And do you think we're at the point now where the Fed can kind of continue with what it's doing and ignore them?
So I think there are, some of the risks that you mentioned. I wouldn't go too far on the default risk, but the China piece is intriguing, and the data is probably most relevant, particularly if there's further slowing in the employment data. So I think because of that, the Fed will keep some degree of optionality. I think there will be, we want to actually see the data before we respond. But I think the burden of responsibility, the burden of proof, is on the data to prove that the Fed should not go and taper in November. I think that's, where they effectively lie on this issue.
Do you think that we're going to be in a world of central bank convergence or divergence? I personally feel like I shift every day on what that's going to be. There's confusion for the ECB as to what the PEP will evolve into and what it means for the asset purchase program, the traditional one. The BOE is also tomorrow. The market is pricing in 2 hikes for next year, which is confusing some. I mean, what are we going to be looking at?
Yeah, I think it is more a story of divergence than convergence, keeping in mind that we've really had very little action from certainly G10 central banks in the past year or so. So it's a low base to shift towards some level of divergence. At the same time, I think there's going to be an awful lot of focus as far as global markets are concerned in terms of what the Federal Reserve is going to be doing. And if there is a real divergence that people aren't talking about, it's really the pressure on China and Chinese policy to ease. So I think, if you're looking at real divergence where one central bank, a major central bank, is going to hike, and a major central bank might ease, I think it's the G2 axis, the Fed and China.
Alan, we're not talking about replacing Powell at the moment a great deal. How would the dynamic shift if we were to get an announcement that he's out and Brainard's in? How much of a recalibration would we need at that point?
Yeah, I think there's still an expectation of continuity if Brainard were to take over the helm. But Powell has been such an arc dove at this point that I think inevitably there would be a little bit of a swoon, a little bit of uncertainty. Uncertainty would translate into a risk-negative response. I think, keep in mind, for the last, 40 years, we've really just gone from someone who's been hawkish to less hawkish to less hawkish, and effectively, to the most dovish Fed chair that we've had in the last 5 at least central bankers, and in Powell. So I think there would be a substantial rethink in terms of have we seen some slight change here, and I could see a very modest negative risk response.
Before we let you go, we got to get your take on the BOE, and I want to bring in what's happening with the UK power prices. We've seen multiple power companies have to go bankrupt. They can't serve their customers because of the power crisis. And I know as an economist, you're going to say, hey, it's transitory, so don't worry about it. But this could be a structural shift, and it fundamentally hurts households. They're going to have to pay more eventually. At the same time, you got the furlough program rolling off as well. How do you factor that in to your growth forecast and to what central banks have to do?
Yeah, I think they're in a real dilemma. So that's a classic supply-side shock, and it's very questionable whether central banks hiking into, what is almost all a supply shock is the appropriate response. I think, what you see in other countries, not least the United States, is there's a mix here in terms of inflation pressures. It's demand-related and it's supply-related. So, the market, I think, is anticipating a rate hike in the middle of next year. To me, I think it behooves caution on the part of the Bank of England not to move too rapidly here. Let this play out a little bit more. Obviously, if they see inflation expectations really on the rise in a material way, on a sustained way, looking further out, 2-3 years out, then they're pretty much forced to respond.